and welcome to our interview series where we bring you face to face with the experts who manage your money. Today, joining me and my colleague Chirag is Vinit Sambre, Head of Equity at DSP Mutual Fund. Vinit, good to have you here.
Hi, good evening, everyone. It's nice to be on your show. Thank you so much for having me today.
Okay. Now, Vinit, let's begin with, you as a chartered accountant, you had the option to dive into auditing and taxation. So can you tell us what pulled you towards the equity markets instead?
Yeah, so before that, let me say that this decision I think worked out very well is what I feel. And going to brief, bit of the background. So I finished my chartered accountancy in 1997. My father was also a chartered accountant. I actually did my articleship with him and had seen him, go through the auditing and taxation kind of work. And even I had sort of got that experience. But after having gone through all of that, I felt that it is, is there an option to explore some other field? Because this, at certain points in time, it becomes a bit monotonous. Your ability to maybe, if I felt that I had bit of an analytical mind, to utilize that to great extent was also, looking like restricted. You just have to keep ticking the numbers. So I felt that let us explore some new things, and which is where the journey started. In the initial phase, I got an opportunity to do research, not as an employee, but as a trainee with CRISIL. And that actually got, me really, excited to look at this field even more keenly, because I think every day was a new learning. Every day was a new thing which is coming up. You are studying new companies, new sectors, new segments, learning about management. So I think these were very unique. These were very interesting. And as I said, every day felt like a new day. Every day felt like a new learning. So I think this is something which was very exciting. And then along the way, I had seen my father also actually, at that point in time, investing into equities, but not making monies because it used to be more on tips. So again, this became sort of a challenge to me that, if is this a business which is driven by tips, or is it driven by any other factor? So I think all of that basically bunched up and led me to get into this equity research, which has panned out till now quite well, is what I can say.
All right. And did your background in CA, did it shape your investment approach in any way, and especially when analyzing mid and small cap companies?
Yes, absolutely. I think, broadly, there are two sets of, professionals which I have seen largely part of this field. One is coming with the chartered accountancy background. The other really is from either an MBA or a CFA. So I think both have distinct advantages and disadvantages. The advantages of being a chartered accountant is your ability to dive deep into the accounts, maybe understand more of those nuances of accounting is slightly better. And combining with, let's say, your analytical mindset, I think that makes it even more, let's say, richer and more valuable is what I feel.
Vinit, now coming back to the directly to equity markets, we have seen Indian equity market relentlessly going up despite some of the global factors going in US or Japan. Do you think this is an investor sentiment led rally? Is it due to the strong fundamentals, or is it due to the mix of both?
So I would say, what is happening right now looks like bit, unreal in nature also to me. So when you speak about these kind of linear up move in the market, last 8 years phenomenal, without any single year being a down year as far as Nifty is concerned. So I think this seems very unusual if you look at the long history of equity markets, both in India and abroad. I mean, the markets are always volatile. You have bouts of good periods followed by some correction, consolidation, and then again, depending upon the triggers, or depending upon the fundamentals, the markets actually take the direction. But I think last few years has been phenomenal. And when you ask me whether it is fundamental or sentimental, I would say it is a bit of both. Started off with more of fundamental, post COVID, when we saw that one by one the sectors started performing well. I think that caught up the market's fancy and investors' fancy rather. And what we also saw is that because people were not having their core activities to do, I think a lot of them joined this the equity market trading activity. So I think now what we are seeing is the your historical returns are driving the sentiments of the investors. While fundamentals are good, we have really done extremely well, is what I can say. We have grown at a CAGR rate of 23-24% over the last 3 years in terms of the earnings. So fundamentals definitely have been a major factor, but more importantly, this is generally how the markets enter into the bull phase and then it gets into the exorbitant phase as well, where early on it is the fundamentals which drives, and then it is the maybe the sentiments, the flows which keeps driving till the time it starts hurting. So I would say that today the valuations have really run ahead of the fundamentals to a certain degree, and hence we would generally advise that investors should either have a very long term view before investing, and they should not look at the rear view mirror and say that last 3 years mein itna return mil gaya to it will continue. So I would say that we should be slightly more cautious and have a slightly longer term view. To some certain degree, the valuations does look like they have run ahead of the fundamentals, and in certain pockets it has become quite frothy. Is also maybe what it looks like.
So, Vinit, going forward in the next 12 to 18 months, what do you foresee in the markets? Will it with the strong fundamentals led rally, or the investor sentiment might shake up going forward?
So see, the way to now think is that, let's say if I just look at the fundamental picture, I spoke about the last 3 years earnings growth delivering almost 23-24% kind of CAGR returns. And on top of which we saw the markets rewarding the investors quite handsomely. But if we now look at the earnings which got released for the first quarter and the expectations for the current year, the earnings anyways are seeing moderation. That even the level of downgrades have sort of gone up. So from a 23-24% kind of growth matrix, we are looking at 13-14% kind of growth matrix. So I think that this is one very important aspect to sort of focus on, and there are multiple reasons for that. We can get into that, but more importantly, the important element is that the revenue growth for many segments has tapered down. Let's say consumption, IT, cement. So we are seeing that some of these segments have seen the revenue growth moderation, and the benefit of margin expansion has already happened. So that is already behind. And hence, incrementally, if one has to look at the earnings growth, it has to be driven by the revenues, and which could take some time, is what I feel. So I see that really from the fundamental viewpoint, market could enter in a phase of consolidation. I don't see there are strong triggers for sharp correction, at least as far as India is concerned. Maybe the global linkage can lead to some bit of volatility, but consolidation is what I'm sort of going ahead with in terms of the fundamentals. And maybe if the markets start frustrating the investors and they start disappointing the investors in terms of the short-term returns, I think which is where maybe investors will take a cue from there, and maybe the flows could affect, and which is where the markets will then start looking more seriously in terms of fundamentals. But as of now, we are okay. The growth is lower, but still we are growing decently as compared to the other markets, and hence markets could sort of maybe not may seek new triggers for higher growth, but largely remain in a consolidation phase.
Vinit, you mentioned valuations running ahead of fundamentals in certain sectors, but no triggers for a sharp correction as of now. So how do you position your portfolios in such an environment? And are you taking any defensive measures or doubling down or high conviction bets?
So I think we have, in terms of our portfolio metrics, we have really always focused on having margin of safety, either in terms of the valuations or the business cycles. So, whenever the businesses are reaching the top of their cycles and the valuations are also on the top end, we become cautious and try to take money out of those areas. So today, large part of the segment, I can say valuations are either too rich or maybe at a premium. So we have to find comfort in terms of the business cycles where the businesses are. And I can quote an example. Let's say 2 years back, when the auto went through a very, very bad phase after the COVID, what we realized is that 2019 was the best year for the auto sector. And after that, the volumes actually just came off sharply. Now, on a low base, and on the low earnings, while the price had also seen some moderation, but the P's were looking high, but they were not high if we normalize those earnings. So the bet was that these earnings will normalize, the cycles will revert, and hence on a normalized earnings, these valuations will look reasonable. So we within the discretionary space, we took an overweight stance on auto, which even today continues. So the point is that we are either seeking comfort in terms of the business cycle or the valuation cycle, and which is how the portfolios are built. There's a very strong philosophy which we can anyways discuss ahead. But the point is that that is how we are trying to maybe make the portfolio more realistic, more defensible, and more fundamental in nature is what I can say.
So Vinit, you spoke about philosophy. Could you just share with us what is the core philosophy of your investment, and specifically to the mid cap and the small cap segments of the market?
Yeah, so I think it has been a very simple philosophy since the time I have started managing the small cap first, and then along the way started also managing the mid cap. So I think we keep looking for three important metrics. One is the quality of business. The second is the quality of management, and third is the reasonableness of valuation. So I think these are the three important metrics, and within which I would say when we talk about the business, we would like to really own the companies. The mindset is to own them with a long-term view. Our turnover ratios are lower than the peers in general, and which means that we are buying businesses and not stock prices really, and we are not getting affected by the day-to-day news as well. So the whole point is that when we are looking at companies, we would like to invest in companies which have long runway available for growth, which are which are definitely having very strong moats. Sustainable moats, because we need that the moats should sort of sustain in for the long time in future, which will allow the companies to keep trading at a premium valuations. We go for businesses which generally generate good cash flows. We have a threshold for ROCs upwards of maybe 16% as of now, long-term ROCs. And when it comes to quality of management, the capital allocation decision is what we monitor in detail. We go back in history 5-10 years to look at how the managements have actually strategized in terms of their capital allocation, which I think is a very, very important matrix, which can lead to big success or failures in future. So I think these are some of the important metrics which we follow as a part of our investment philosophy, which, as I said, boils down to three important pillars. One is quality of business, quality of management, and third is the valuation. So, as I said, when it comes to valuation, either we are seeking absolute comfort in terms of reasonableness of valuation. If not, then the business cycles should be in our favor. Is basically the metrics which we sort of look at for as a part of our investment philosophy.
There's been some correction recently in mid and small cap stocks, but overall, they've been performing impressively. So do you believe this momentum is sustainable? And how do you balance the high valuations with the increasing small cap allocation in your portfolios?
Yeah, so see, I think the way we started in the beginning, I spoke about the valuations sort of running ahead of the fundamentals. I think it is slightly more glaring when we look at the mid and small caps right now, because the investors' interest in general has been pretty high there. And I think very obviously because generally the sentiments are looking to capture the historical trends. And historically, it has been seen that the mid and small caps have delivered outperformance over the large caps. So I think principally I am of this belief that over long periods of time, let's say 5 years, 7 years, 10 years, the mid and small caps as a segment does have the ability to outperform the large cap, and the matrix is pretty simple. The size and scale of these companies as compared to the large caps is lower, and which allows them on that base to show a growth which is higher than the large cap. So if we are talking of general economic recovery and economy growing at 7-8%, I think, and a broad based recovery, at the lower end of the pyramid you will have these small and mid caps, very relevant companies, which will have the potential to outgrow in that framework. And as these keep compounding at a rate higher than the large cap, over a long period of time, these will sort of outperform. Now, the risk in today's environment is that the mid and small caps have also achieved a higher valuation range as compared to the large cap. So maybe there is a phase of adjustment which takes place where the valuations maybe the gap becomes narrower, and which is a phase where it could mean that the mid caps and small caps could for a while underperform the large caps. But for those who have faith in the category, who are long term investors, I would still believe that they should maintain a decent asset allocation mix between the large and mid caps and hold it for long term, because in long term I still believe that their ability has not got affected. Just because of valuations, they could have 1 or 2 years of maybe relative challenge performance, but beyond that I believe that they should continue with their outperforming journey, is the way I would sort of put it.
Markets are always dynamic, and we see sector rotation very frequently. So in that scenario, how do you adjust your portfolio? And in the current market scenario, are you finding any emerging sector where you're bullish on?
So as I said, I think the important criteria for us, one, I think the philosophy which we follow, where we have these aspects or these filters which we look at, that is number one. Number two, you're right, I think portfolio sectoral allocation also depends upon where in the cycle these businesses are today, and which is what we keep sort of making the shifts around the segments which we believe could outperform in the reasonable time period going forward. So today when we are looking at the business cycles, I would say that broadly consumers as a category has been underperforming in terms of their business metrics for a good 1 to 2 year, and they are in their low cycle today, and for all the right reasons. We know post-COVID, the challenges the low income and the mid-income household they faced, and which has not led to a decent carry through in terms of the overall consumption demand. Whereas the large part of the growth was really led by the investments, and that too largely coming from the government, the central government. So I think that has pushed the growth to a great extent. But I believe that it's been a good 2 years. The wage levels have gone up. We are coming out of a good monsoon. The inflation is also sort of under control. So within consumption, I think we have to look at different pockets. I believe that it's in a good low cycle today. We need to select pockets within the consumer basket. It can be both from the discretionary and the non-discretionary category as well. So that is one area which we are sort of looking at. And anyways, our exposure in the small cap and also the mid cap is decent to this category, is what I can say. Similarly, when we look at the IT as a segment, even that sector has gone through the challenges of slowing growth over the last 1 year. And that is linked to more the international economy, where they have their own challenges. The developed world, they have their own challenges, but we sense that as the world central banks, they start working towards making the economy work by way of reducing the interest rate, I think those will again create pockets of opportunity for our IT sector. So we have also sort of looked at those, and we have looked at increasing our exposure out there. So I think these are broadly areas where we are trying to find opportunity, not so much in terms of valuation, but more in terms of the cycles of the businesses. There's one more segment, which is the specialty chemical, which has again gone through a long drawn underperformance and slower business momentum. So I think which is there also. Again, it's not a homogeneous sector. Each company is a different company, so we have to be selective. But that's one pocket where we would be able to see recovery over the next 1 or 2 years, and we are trying to look at some of the businesses in that category.
All right, now, Vinit, now that we've discussed your overall philosophy and your view on market segments and specific sectors, let's move on to some fund-specific questions. The DSP Midcap Fund hasn't been able to outperform its peers since 2020. So, what's been holding it back, and how do you plan to steer it back on track?
Yeah, I think very important. And let me, as a background, mention that most fund managers they who follow really very strong philosophy of identifying companies and businesses and strategize for the portfolio. I think most of them have seen phases in their cycles, and I think for us, the phase starting 2020 was challenging, where the underperformance has actually got extended and has hurt the long-term performances for the mid cap and to some extent the small cap fund as well. So again, I would say the reasons go back to our philosophy, where we generally, as I mentioned, would try to focus on high quality businesses. We are more buy and hold nature, low churn, and all of that has not worked. So structurally, when we look at the markets since the post-COVID, the sectoral rotations has been pretty quick. I think most sectors saw short period of outperformance, and then people moved on to different sectors, and we were maybe not as quick. Combining with the fact that we held some of these long-term defensive businesses within the healthcare or the specialty chemicals didn't also add to a performance, so that also maybe led to some detraction in terms of the performance. Plus some of our own misses of not being exposed significantly to segments which were benefiting out of the investment climate. So I think these were broadly the combination of what led to this underperformance, which actually pulled down our long-term underperformance. The another proof of what we have been saying could also be seen when we compare our mid cap portfolio to there's a mid cap quality index as well. When we compare it to that, we are pretty okay even in this last 3 years period. So just to draw comfort from the fact that while we have maintained quality, I think versus a quality benchmark we have done well, but our ambition is to beat the mid cap index. And I think gradually the last 1 year or so has been a bit of a good recovery phase for us. We have been gradually recovering from the lows. We are seeing that some of the businesses which had underperformed or led to underperformance of our portfolios, those are now sort of coming back. The likes of healthcare, which I mentioned, some of the companies within the materials as a category, the pipes, agri, all those companies now seem to be sort of coming back. And I think eventually, as we say that the markets will eventually track the fundamentals in the long term. So we are very confident, comfortable that the adjustments will take place. Some low quality or narrative based companies within the index will definitely see some correction. Good companies will sort of bounce back, and this is how the gaps will keep narrowing. So I would say that we have we understand where we are, what has led to the underperformance. We have also made some changes. Some names doesn't require change. So I think a combination of all of these factors is what we feel should allow us to come back. And some proof of that is visible in the last 6 months, 1 year. And hopefully the next 1 year, we see even better recovery.
Vinit, is it the similar for the small cap also? Because that fund is also trailing since 2022.
Yeah, so broadly similar, and if we, but in case of small cap, I think the pressure was slightly lower, and we had. So let's say if I can say that mid cap was a bit chronic, it continued, sustained the underperformance. Small cap did recover once, again it fell back, and now it is again on a path of recovery. Small cap had slightly, small advantage of being more diversified, more broad-based in terms of the segments which it was exposed to, so that allowed it to come back. And as far as the small cap is concerned, if we just stretch our investment horizon and look at the 5-year return, I think we are broadly beating the benchmark, so it's not as bad. And I think that fund is also now on a path of recovery. There are some bets or exposures which we have taken where we are very convinced about those businesses, and we have not let down on those companies. It has hurt us. We are okay with some of that pain. We have to endure that pain for the larger benefit that as these companies see recovery, I think they will deliver very smart outperformance is our belief, and hence that's how the portfolio should also see the reasons to sort of bounce back eventually.
Both the schemes which are one of the important schemes at the fund house have seen some of the beating, as you mentioned, mid cap as well as small cap for the prolonged period of 2 to 3 years kind of thing. So how has it influenced your investment decisions? Has it anyhow changed or influenced decision changes in the current market scenario?
You're right. We have to keep introspecting. We can't be very dogmatic about, this is what I'm going to follow. So, broadly, we have not diluted on our philosophy. So, philosophy stays. So, if you look at any company you select, I think they will broadly meet the philosophy. But I think where we have done some course correction is that, let's say, in case of mid cap, we felt that, let's say, we were more concentrated on in few segments which some of them did well, but we felt like we need to diversify some bit. So we did carry out some diversification within that. In case of the understanding of the cycles, we tried to deepen our knowledge and understanding of businesses and trying to understand even more deeply that are we missing out on trying to identify and pick up some of the recoveries which are taking place. So sharpened our focus and did some changes to the portfolio. Some, as I said, we just stuck to our framework. We said that it's no point, even if we are going through the pain, we need to live through that, because I think if we are convinced about a company, if the managements are on the right track, they are executing their strategies well, we don't want to cut off the journey, because we know that eventually these managements are the ones which will deliver significant outperformance and wealth creation eventually, and that has been the experience also of the last 14-15 years. So we have stuck to some of them, and I think when we look at the recovery over the last 1 year, also large part of the recovery is coming out from these strong bets, and some, as I said, is because of the changes which we are carrying out. So I think it's a combination, but we will not let down our guards, and we will not let down the guardrails which we have in terms of the framework or the philosophy which we are following in terms of the companies in the portfolio.
Vinit, you mentioned that you've been bullish on sectors like consumer discretionary, there's chemicals and materials in your mid and small cap portfolios. Also, we can see that. So even though they've struggled over the last couple of years, so I'm trying to understand what's the reasoning behind this confidence, and also how do you ensure your conviction in these sectors doesn't lead to over concentration risk?
No, so I think the portfolios are fairly diversified when we look at each of these pockets. So consumer is a large category, and within there there are a lot of sub segments. You will have a retail, you will have a QSR, you will have building materials. So auto. I mean, there are sub segments which are driven by diverse factors when it comes to their growth. So we are definitely monitoring each of those and trying to size up our position depending upon where in the cycle are each of them. So let's say if we had higher exposure within the consumer in the auto space, that did work well for us, and that was a conscious decision to have. We at a point in time we cut our exposures to QSRs, and because we felt that they were in the let's say slightly longer period of a slow growth environment. And when we see, the factors of recovery within those, then we will want to size up those bets. So we have been within those baskets. We have been working around the sizing as far as these subsegments are concerned, just to make sure that we are not maybe overly getting exposed to one specific segment which is driven by one specific factor. So I think that is how we are sort of trying to solve. The other answer to your question is that, again, I think we have to respect the cycles for all types of businesses. I think every business is cyclical. We can't even say that FMCG is a linear business. We have seen that they also go through a period of 3-4 years of lower growth environment. So I think all businesses are cyclical. We need to understand that. And if the businesses have gone through a low cycle, after some period they will also come back. So the judgment can go wrong in identifying how long will it take to come back. Now we are watching the various factors which keeps driving these businesses. So maybe if monsoon is important factor, if rural agri income levels there, inflation, if these have been the factor which have hurt the performances, those factors are reversing now, and hence we believe that we need to then take a call and take a bet that these factors reversing will mean that some of these companies will start seeing growth coming back. We have seen so much of real estate getting sold in the last 3 years, but that has not flowed down to the building materials in a big way. Which means that, is it not going to come to them at all? No, I think it is a process in that whole when the real estate building stages start, it is the final stage when all these materials are getting used. So we know that 1 or 2 years down the line, these building material as a segment should look well. So which is where we are trying to sort of take cues from some of these and maybe expose ourselves. Similarly, I think agri has last 2 years were not so great for the agri sector globally. Also, things have been bad. And hence this year the monsoons have been good, inflation is low. Some of the companies which we owned has really shown good performance. So I think those are the things which we keep monitoring and sort of to build our hypothesis around these segments, and which is where we are exposed. But by the way, let me also assure you that broadly talking about one category, it doesn't mean that we are overexposed within our portfolios. We have different flavors within those large segments as well.
Vinit, we have noticed that the DSP small cap ranks low in terms of the liquidity during the stress test. So should this be a concern to the investors, or is there any bigger picture which they should consider?
No, so I think, see, this was always the case with the category. I mean, ever since we started managing, it was earlier known as micro cap and then small cap. The challenge of lower liquidity is always there with the category. But since beginning, I think we took a decision that we would want to stay true to the label when it comes to the small cap. And if you notice, we are, I think, the only fund where we do not take exposure to large cap in the small cap fund. So even if there's a provision which allows us to have large caps, but we have stayed away from that. In mid cap, we do take the exposure into large cap, but small cap we have avoided, because we said, let us be pure. Let us give the investors the benefit of seeing very powerful wealth creation from the small cap companies, because we do believe in the company's long-term ability to deliver strong wealth creation. There are very capable management within the small cap universe who can do that. There are a lot of segments within India which are segments which will keep growing for many decades. As I said, building material is one category, agri is one category, where you actually don't have a direct play available within the large caps. So there are the only way to play is either through mid caps or small caps. Sugar as a business, I mean, there are only small cap companies available, but it's a large segment one can't ignore. So I would say that you have really I would say great businesses, great companies, great management available within these small caps, and we want to provide that opportunity for all our investors to benefit from that. And hence we have sort of stuck to the mandate in case of small cap and not got into the large caps. And that is one of the reasons of that liquidity challenge. But the way to think about it is, Chirag, that when we talk about good quality companies and good quality businesses, what may look like a challenge in terms of the liquidity, at that point in time, also sometimes is misplaced, because a good quality company will always have demand coming out from good investors. So if we have to, at some point, if we feel challenged and if we offer a small marginal discount, it can immediately get offloaded. So what we see as number of days to liquidate, the reality could be different from what we actually see in numbers. But anyways, I think we have tried to solve that by way of holding good quality business, by sticking to our mandate of small cap. And we believe that while those numbers are relevant for investors to know, we have started disclosing. But for long-term investors, it will not matter as much as what I want to assure through your channel.
Okay. Vinit, specifically, if we look at the liquidity situation in the small cap thing, and specifically, as you mentioned, that it was a micro cap and then later it became a small cap. So how do you manage these during the market drawdowns? Is it a concern, or how do you manage it?
So as I said, I think we have bare minimum of cash. We have around 5-6% cash in the small cap. So since beginning, I think we have, in general, because of this challenge, we have, as compared to other funds, we have maintained slightly higher cash levels. We have high quality mid caps also, around, let's say, 14-15% is exposure to the mid caps as well. And just in case of an emergency, these could be sort of used to liquidate ahead. And then maybe if there are any such periods where we face those challenges, it can be addressed. It's since the time I'm managing this fund, we have gone through a lot of the big events, including COVID, 2008 Lehman crisis also is what we saw. So I think we have gone through major challenges. We have seen, the fund has also seen there is a long life available. The companies which we have invested into, they run on a going concern basis, and we see their own lives being more than 50, 70, 100 years. There are some companies which have been in existence for 100 years and part of our portfolio. So I would say that it is more, one should sort of think about the businesses. Liquidity will change every day. I think it is a changing number, but the businesses are more constant and certain. We want to try to maybe identify these good businesses and create, as I said, a good experience for our investors through the small cap fund.
Finding value in mid and small cap space isn't really easy. So, and you mentioned the sectors that you're bullish on, but are there any specific sectors or industries where you see untapped potential right now?
So, see, I would say that most of the segments are really explored well. I think the 2013-14 was a period where there were a lot of opportunities which were looking very interesting, and the cycles were also sort of inflecting upwards. So I think we found many cases where we saw multi-bagger returns. But I would say now investors, because a lot of the segments have got already explored, and we are reached a valuation point from where one should not build those kind of very high expectations from these companies broadly, and at a high level, I want to sort of caution first. Now, coming to segments, I think that the way India has changed in terms of the last 3 years, a lot of the categories which were ignored in the past have got a new lease of life. So maybe some of the segments like, I'm just talking from the business viewpoint, not the valuation viewpoint. Valuations is something which one has to keep in mind before one is investing. So don't take these as advices from my side. But I'm saying from the business viewpoint, I think the opportunities which has grown, like for example, defense has seen a very significant opportunity coming up because of the indigenization which the government has come up with. Water related projects never used to see high allocation in the budget earlier, but now we have seen a good amount of allocation coming for the water related projects. Same is the case with the railways as a category, where they have seen significant exposure. Now semiconductor is going to become a big. So I think, see, these are new areas which we never spoke about early on, and we have just begun the journey out here. So maybe over the next 10 years, we will be looking at a very different India, where manufacturing will become quite significant. We have to find pockets within manufacturing which can do well. We anyways, I think, as quality, we have the prowess, we have the capability, we have proven our skills, and why I'm saying this is that we are anyways exporting a lot of our manufacturing within different segments, pharma, auto, IT. So the prowess is there. It is just about expanding, growing, getting support from the regulations government, and I think we will have even a larger opportunity to grow. I was actually talking to a few people in the industry, and what I realized is that so one is what is happening in India, and the other is what is happening globally. That is also very supportive. Globally in Europe, I think that there's a big challenge. They want to shut down a lot of the capacities. Their economies are not doing well. So I mean, that also is an opportunity. A lot of the Indian companies are looking at acquiring assets there, which will mean that they will have access to their customers, they will have access to technology. So I think we are in a very different kind of paradigm today, and a lot of opportunities are actually opening up. So we need to be just open about these things, and see how best we can try and participate through our portfolios.
When evaluating the small cap stocks, what are the non-negotiable factors and which are the qualities which will not compromise on?
Definitely governance is one where we have laid a very high standard upon, and in fact we internally we have one analyst who's actually, we call him a forensic analyst or a skeptical analyst, and his job is only to carry out the forensic research on the companies where we are investing. Because this category is fraught with so much risk, we feel that it is important to have these elements pretty clear. And hence, what is non-negotiable is any compromise on the governance, any compromise on the their accounting, related party transaction. All those things we do not tolerate. And let's say, if by accident, if we have got exposure and we get red flag later on that there are any issues, then we sort of in the past have taken decision to knock that position off. So I think that is something which is non-negotiable, and the others are, I would say, mostly linked to the let's say, as I spoke about, the high point in the business cycle and high point in the valuation cycle. We would not want to sort of have such exposures as well. So I think these are the areas which we would sort of try and avoid: governance, accounting frauds, accounting issues, and the top business and valuation cycles.
Vinit, extending to these questions, for small cap thing, there are very limited information available in the market. So how do you overcome these challenges? Is there any particular way which you get the information? Any additional things at DSP Mutual Funds which you follow to gather more information of a particular stock?
See, I think this is also an edge in a way, when not many people are researching the company, which means that the knowledge about the business, knowledge about the management is a little less, and it is not well known. But I think the last few years, it is now becoming more accessible to a lot of people. There are more people who are joining the race. So I think now there are not as much as unresearched or ideas which are not known as compared to what it used to be in the past. But still, I think this is a segment where this becomes an advantage. What we try and do is that we have a very strong team of our own research analyst who is involved in talking to management, doing a lot of channel checks, and I think the primary source of information becomes important when we carry out the channel checks through the dealers, through the distributors, through the competition, through the peers. So I think all of those gives us good cues, and I think we have enhanced our technology template as well. We have created our own platform internally, a research platform, which we are trying to make use of, and try to we try to what I can say, backtest some of the data points to get more strong conviction on the names which we are tracking. So I think these are the important ways in which we keep tracking. But I think more importantly, it is the strong understanding of the management, strong understanding of the business, which becomes a core strength when it comes to the small cap companies.
Right now, before we wrap up this interview, one last question. For retail investors who are interested in small cap stocks, but they might be hesitant, what advice would you give to help them make more informed decisions and manage the risks involved? You mentioned keeping a long-term view and being cautious, but would you like to add on to that list?
No, so I would say that I've seen that most people they generally mention that we have a strong philosophy of identifying companies. We look at these areas, but I have seen that as you progress in the bull market, as it keeps going higher and higher, what people understand as the good qualities of business sometimes may not be well represented, and it could be an illusion of your understanding of that business, because as they say ki sawan mein sab hara hi dikhta hai. So in good times lot of bad things get hidden, and it could give wrong signals to the investor. So my the advice one to the investors is that this is a sector which is fraught with a lot of risk. Risk should never be ignored. While last 2-3 years didn't show up, but markets will definitely show its true character at some point, and it will keep showing the volatility. And for every one a successful company in a small cap, there will be 5 or maybe 10 which are unsuccessful, and 3 or 4 which could actually also blow up. So I think these risks should always be kept in mind, and the best way for investors who do not understand or they have less ability to take the informed decision, I think the best way is to leave it to the experienced fund managers. I think that's the best way to tackle the small cap as a category. So I would say that use that, and or build your own capability, get informed decision, do a lot more checks, be very disciplined. People also tend to lose discipline as the markets keep going higher and higher. There is a dilution in the checks which one wants to do. So I think those are the things which I would want to just maybe lay out for all kinds of investors out there.
Well, with that, time for us to wrap up this chat. Thank you, Vinit, for taking the time, and thank you for this lovely interaction.
Thank you. It's my pleasure, and thanks for good questions you all have asked. Thanks.
Thank you.